Most traders don't fail because of bad strategies. They fail because of what nobody told them. Not the YouTubers, not the courses, not even the books. There are things pro traders quietly keep to themselves. Habits, mindsets, truths that feel uncomfortable. And today, right now, you're going to hear all of it. Stay with me. This one is different. In the next few minutes, I'm going to show you 3 brutal truths that professional traders never say out loud. These aren't tips about charts, no indicators, no patterns. This is about what happens inside your head and inside your account when you don't know these things. By the end of this video, you will trade differently. I promise you that. Let me tell you about a guy named Marcus. Marcus was sharp. He studied the markets every day. He had a solid strategy. He knew support and resistance. He understood basic risk management. But Marcus was losing money consistently. Every single month he ended in the red. His friend, also a trader, was making quiet, consistent gains. Not massive, but consistent. One day Marcus sat with his friend and watched him trade. You know how many trades his friend took that entire day? Just one trade. Took it, managed it, closed it. Done. Marcus, on the other hand, he had placed 11 trades that same day. 11 trades. Most of them losses. Here's the thing, and this is the part no one talks about. Overtrading is not a strategy problem. It is a psychology problem. Think about it. Why do you take trade after trade, even when the setup isn't there? Because your brain is wired to seek action. When you're sitting in front of charts and nothing is happening, your brain starts to feel uncomfortable. It tells you, do something right now. That discomfort, it is not your edge. It is your enemy. There's even a name for it in psychology. It's called action bias. The need to feel like you're doing something, even when doing nothing is the right move. Pro traders have learned to sit on their hands. They have learned that waiting is a skill, a real profitable skill. But nobody wants to make a YouTube video about sitting and waiting, right? That doesn't sell courses. Ask yourself this. How many of your losing trades last month were trades you knew, somewhere deep down, you shouldn't have taken? Be honest with yourself. Most traders, when they review their journals, find that 60, 70, sometimes 80% of their losses came from trades they forced, not trades where the strategy failed. Trades they manufactured out of boredom or impatience. So what's the fix? How do you actually stop overtrading? First, you need a rule, not a wish. A rule like, I will only take a maximum of 2 trades per day, or I will only trade between specific hours. Hard limits, written down, non-negotiable. Second, you need to understand that a day with no trades is not a failed day. It is a protected day. Your capital is still intact. You are still in the game tomorrow. Professional traders think in weeks and months. Beginners think in minutes and hours. Third, keep a trading journal. Not just your entries and exits. Write down why you took each trade. What were you feeling? Were you bored? Were you chasing? Were you trying to recover a loss? Patterns will emerge. Patterns you cannot ignore once you see them. Marcus started doing this. Within 6 weeks, his win rate improved. Not because his strategy changed, but because he stopped taking bad trades. That is the first thing pro traders that don't tell you. Discipline is not about taking great trades. It is about refusing bad ones. Now I want you to think about your worst trading day ever. Maybe you lost 3 trades in a row. Maybe you blew a big chunk of your account. Maybe you felt sick to your stomach and couldn't sleep that night. What did you do the next morning? If you're like most traders, you went back in hard. You doubled your position size. You told yourself you'd win it back. This has a name, revenge trading, and it has destroyed more accounts than any bad strategy ever could. Let me tell you about a trader named Tyler. Tyler was actually a good trader. Seriously, his strategy had an edge. His backtesting was solid. His risk management was textbook. But every time he had a losing streak, even just 2 or 3 losses in a row, something clicked off in his brain. He stopped following his rules. He started taking bigger positions. He started moving his stop losses further away. Within a few months, Tyler had lost 60% of his account, not because his strategy failed, because of what happened in his head after losses. Here's the psychological truth behind this. Losses hurt more than gains feel good. This is called loss aversion, and it has been proven over decades of research in behavioral economics. $100 loss feels roughly twice as painful as a $100 gain feels pleasurable. So when you lose money, your brain enters something like a danger mode. It wants to immediately fix the pain. It pushes you to act fast, act big, and get that money back right now. But the market doesn't care about your pain. The market has no memory of what it took from you. And chasing a loss is one of the most dangerous things a trader can do. Here's what professional traders actually do after a loss. And this is the part they never post about on social media. They snot for a minute, sometimes for an entire day, sometimes for 2 days. They detach. They go for a walk. They exercise. They do something completely unrelated to trading. They let the emotional charge from that loss dissipate naturally. Why? Because trading from an emotional state is not trading. It is gambling. Your prefrontal cortex, the rational part of your brain, is actually less active when you're emotionally activated. You literally cannot think clearly when you're upset. The market will still be there tomorrow. The setups will come back. But if you blow your account chasing revenge, you won't be there to take them. Tyler eventually learned this the hard way. He rebuilt his account, smaller, and this time he added one rule to his system. After 2 consecutive losses, he is done for the day. No exceptions, not because 2 losses means his strategy is broken, but because 2 losses puts him in an emotional state where his third trade is almost never a rational decision. He calls it his circuit breaker, like an electrical circuit that trips before it causes real damage. What's your circuit breaker? Do you even have one? If you don't, that's the second thing pro traders have that you might be missing. They don't just manage their risk on each trade, they manage their emotional exposure for the entire day, the entire week. Risk management isn't just about position sizing and stop losses. It's about knowing when to step away from the screen entirely. Build that rule into your system. Define exactly when you walk away. Write it down before the trading day begins. Not during it, not after a loss, but before, when you're calm, when you're thinking clearly. That version of you is your best trading self. Honor that version by building rules that protect you from the emotional version of yourself. All right, we're on the third truth. And this one might be the hardest to hear because it goes against everything social media tells you about trading. Let me paint you a picture. There's a trader named Sarah. She has a strategy with a 55% win rate. Nothing special. Just over half her trades are winners. Her risk to reward ratio is 1 to 2. She risks $1 to make $2 on every trade. She takes 5 trades a week. That's it. 20 trades a month. She doesn't have a flashy setup. She doesn't trade exotic pairs. She doesn't stay up until 3 in the morning watching Asian markets. She is consistent. Week after week, month after month. At the end of a year, Sarah has grown her account by 42%. Now let's look at James. James is talented. He really is. Some months he makes enormous returns. 30%, 40%, one month even 60%. But then he has a bad month, down 35%. Then another bad month, down 20%. His curve looks like a roller coaster. Sometimes way up, sometimes way down. At the end of the same year, James is actually down 11%. Who would you rather be? Most beginners would be drawn to James. The big months look exciting. The highlights look amazing on a screenshot. But the reality is that volatility in your returns is a warning sign, not a badge of honor. And here is the psychological reason why so many traders are more like James than Sarah. It's because of something called variable reward conditioning. This is the same mechanism that makes slot machines addictive. When rewards are unpredictable and variable, sometimes small, sometimes huge. The human brain becomes more attached to the behavior, not less. The unpredictability itself becomes exciting. The dopamine hit of a massive win keeps you chasing that feeling. And that feeling pulls you away from the boring, consistent, process-driven approach that actually builds wealth over time. Consistency doesn't feel exciting. That's the whole point. Pro traders are not excited about their trading, not the real ones. They are methodical. They are almost boring. They could describe their trading day to you in one sentence. I waited for my setup, it appeared, I took it, I managed it by the rules, I closed it. No drama, no big story, no emotional roller coaster. That's the goal. That's actually the dream. But how do you get there? How do you build that kind of consistency when your brain is wired for excitement? Step 1. Define your process, not your outcome. Most traders set goals like, I want to make 5% this month. That is an outcome goal. You cannot fully control it. Instead, set process goals. I will only take trades that match my exact criteria. I will never risk more than 1% of my account on a single trade. I will review my journal every Friday. Those you can control completely. And when you control the process, the outcomes take care of themselves over time. 2. Measure consistency, not just profit, every week. Ask yourself, did I follow my rules? Not did I make money? But did I do what I said I would do? A week where you followed every rule and lost money is a good week. A week where you broke your rules and made money is a dangerous week, because it teaches you the wrong lesson. Step 3. Shrink your position size when you're learning. Seriously. The single biggest mistake new traders make is trading too large, too soon. When position sizes are too big, every trade becomes emotional. Every loss feels catastrophic. Every win feels like it could have been bigger. Trade small enough that each individual trade doesn't make you nervous. That's the size where you can actually think clearly and follow your process. James eventually figured this out. He spent 3 months trading tiny positions, almost embarrassingly small. But during those 3 months, he built real consistency. He stopped chasing. He stopped revenge trading. He learned what it felt like to just follow the rules. Then he slowly scaled up. And his curve started to look more like Sarah's. That ran transformation, from exciting and volatile to consistent and calm. That is what professional development in trading actually looks like. Nobody posts about it, because it's not flashy, but it is real. Okay, let's bring all of this together. 3 things that pro traders quietly know and rarely talk about. Number 1. More trades do not mean more money. Overtrading is a psychology problem. Your brain craves action, but the market rewards patience. Your job is not to trade all day. Your job is to wait for the right moment and take it with discipline. Build a daily limit. Keep a journal. Protect your capital from boredom. Number 2. Losses are not the enemy. How you react to losses is the enemy. Loss aversion is wired into your brain. After a loss, your emotional state shifts, and from that state you almost always make worse decisions. Build your circuit breaker. Define in advance when you walk away. Trade the next day from a clear head, not a wounded ego. Number 3. Consistency is the strategy. It is not sexy. It is not exciting. But it is the only thing that actually compounds over time. Measure your process, not just your profits. Trade small until your discipline is solid, then scale. The goal is not a great month. The goal is a repeatable, sustainable edge, applied calmly, week after week, year after year. Marcus stopped overtrading and his win rate improved without changing a single strategy rule. Tyler installed his circuit breaker and stopped blowing his account on revenge trades. Sarah proved that 55% and 1 to 2 risk reward, applied consistently, beats the trader chasing big months every single time. These are not theories. These are real patterns that repeat themselves in the trading world every single day. The market is not your enemy. Your undisciplined mind is. And the moment you start treating trading like a craft, something you refine patiently over time, everything starts to shift. You stop trying to get rich this week. You start trying to get better this week. That shift alone will protect your account more than any indicator, any signal, any strategy ever could. If this hit different than what you usually watch, hit subscribe. Every week I put out content like this. No hype, no get rich fast. Just the real side of trading that most people are too afraid to talk about. And next week, we're going deep on something that destroys traders silently, without them even knowing it's happening. It's called the confidence trap, and it's the reason why traders who start winning often blow up bigger than the ones who were losing from the beginning. You don't want to miss that one. Skosturb. I'll see you there.